This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter deals with audit, both internal and external audit. Now, audit is a form of what's known as assurance. And assurance is, get his writing, assurance is where you don't do something yourself, but you get another party to basically do some sort of checking for you. So if I, let's say, was having a house built, I would want to make sure that the house was built properly. So I would get some sort of expert, a surveyor, an architect, something of that sort. I would ask them to go and check the house or the extension or whatever work I was having done. The architect or surveyor or engineer would be ensuring that the house met certain standards, building regulations, engineering safety standards and so on. So there are agreed standards. It is a responsibility of the builder to have built the house properly. And the architect or engineer will produce a report for me. I'm this other party. I get the architect to do this because I might not have time to do it, and I certainly don't have the skills to do it, to report on the safety of a new building. We, of course, will be dealing mainly here with assurance and audit relating to financial matters. And here we have the auditor, if we're dealing with, let's say, an external auditor to start with, an independent external auditor. They will be examining what are known as financial statements, so we have to see what's meant by financial statements. They will make sure the financial statements agree with accounting standards, and they will carry out their work according to auditing standards. So we know, we have an idea of how good this checking procedure is, this assurance procedure actually is. It is a responsibility of management to produce the financial statements, and there will be a report produced by the auditor, the auditor's report, and that will be sent to the shareholders. Because again, the shareholders can't do the work, there aren't too many of them, they don't have the expertise, they may be geographically a long way away from where the company actually is, so the auditor is appointed. The two sorts of auditor we'll be looking at is an external auditor. This is where the report produced by the auditor goes to the members or shareholders. And then we have internal audit and internal auditors, and this is where the report they have produced will go to the board and the management of the company. Now, why do we need external audit? And it's really the old story that there's this distinction between the people who actually own the company, the shareholders, and in principal agent theory, these are supposed to be the principals. And you have the directors, and the directors are the agents of the shareholders. In other words, the directors should always be acting in the best interest of the shareholders to maximize the shareholders' wealth through profit growth, dividend growth, and maybe share price growth. The trouble is, there's this separation really in companies once they get to any size. Once you don't have the shareholders working in the company, the shareholders are investors, relatively passive investors, and they turn the day-to-day workings over to the directors. And how do we know the directors are doing a good job? Well, the directors will be required to produce financial statements. This is annually. But of course, the directors may produce annual statements, financial statements, which are incorrect or which are too optimistic, which give maybe a wrong impression of the profit of the company. So what happens is the auditors appoint the independent external directors, and the auditors examine the financial statements. So the assurance is given by the auditor, appointed by the shareholders, and there's going to be a report coming back here, part of the financial statements. The auditors report back to the shareholders, hopefully saying that the financial statements show what's called a true and fair view. So this is the once per year checkup, if you like, that the directors are acting properly, and the evidence that acted properly is the financial statements, and we believe the financial statements because the external auditing process adds credibility to that. Note this relationship here. It is the shareholders who appoint the independent auditors, and the independent auditors have a responsibility to the shareholders, not to the directors. The auditors, the external auditors, are not the puppets, if you like, of the directors. Now, what are the financial statements? And these are produced usually annually from the financial records. And financial statements consist of 5 parts. There is a statement of financial position, sometimes called balance sheet, or that's the old terminology. A statement of profit or loss, which in old terminology used to be called the profit and loss account. A statement of cash flows. Notes to the financial statements, explaining and divulging lots more information about the figures which are on the statement of financial position and the statement of profit and loss and so on. And there's a statement of movement and reserves. Note that the financial statements does not include the director's report or the chairman's report. So those are not part of the financial statements, and the auditors do not report on those. The only time they'd ever get involved with those is if the director's report said something which was contradictory to what was actually in the financial statements. Then the auditors can point out that the director's report is not correct, really, but it is not part of their job to audit the director's report or the chairman's report or the nice pictures and pie charts and so on that you very often get at the beginning of a glossy set of financial statements, the company's annual report. And the objective is that the auditors would like to be able to say, and indeed the directors would like to be able to say, that the financial statements show a true and fair view, or present fairly is sometimes another phrase used. It doesn't say they're accurate, it doesn't say they're correct. It uses these words, true and fair. And what do they mean? Well, true is pretty well meaning accurate. Not quite, but it's accurate is quite a close word to true, that the figures are relatively accurate. Okay. Fair is a much more difficult concept. This is really to do with judgment. So there's sort of a distinction maybe between true, figures that could be true but not necessarily fair. If we were to look at a company and it had its current assets, and its inventory, its receivables, and its cash, so there we have 1,300. Now with the current liabilities here, let's say the current liabilities are 1,000, like that. Now this is what's called the net current assets. So now you will probably know that we have to pay the current liabilities relatively quickly, certainly within 12 months. And what you need to pay the current liabilities is basically current assets. This is tend to be what you're matching. And if you were to see this on the statement of financial position or something like this on the statement of financial position, you would be worried because there's the great majority of the current assets in here is inventory. And inventory can sit around in a warehouse for months and months and months. You need customers to volunteer to buy it. And really, looking at this, there's only 100 in cash to pay 1,000 owing to your suppliers, say. Even when these debtors pay you, there's only 300 then in cash to pay 1,000. This is probably indicative of quite difficult liquidity. So we can say this is true and fair, that the figures are correct, but it's also fair because it lays open to us to see that the liquidity of this company could be really quite difficult. Now what happens if instead of presenting information like that, they simply presented the information like this, where you had current assets 1,300 and current liabilities 1,000. And people could be looking at that and saying, well, the current liabilities are way ahead or substantially ahead of what the current assets are well ahead of what the current liabilities is. It's not too bad. If you know anything about ratios, one of the ratios you can do is the current ratio. And the current ratio here, current ratio is current assets divided by current liabilities, is 1.3. And there's a kind of rule of thumb that if the current ratio is greater than 1, then people are relatively relaxed. But of course, by combining these three figures into 1,300, you're actually concealing a lot. 1,300 is accurate, it's true, but it's not quite fair. And there's perhaps an effort here to mislead the shareholders to thinking that the company's pretty safe. Now, if they cannot say that the financial statements show a true and fair view, and that could be because there's basically what's called a misstatement. So basically the financial statements show an error. Maybe they've overstated the value of inventory or something like that. So there's a material misstatement in here. We're always looking at material. We're not looking at the odd $5 wrong here and there. We're looking at something which is material. If there is a material misstatement, then you have what's called a modified opinion. You can't simply say that the financial statements are true and fair. And the other time you can get what's called a modified opinion is if the if the auditors simply can't get the information. So they've put 1,000 in here into inventory, but if the auditors were not told when the inventory count was, and the auditors can't actually go and count how much there was, then they simply don't have sufficient appropriate evidence here. So this here is basically a lack of evidence. And the auditors would be silly to say the financial statements show a true and fair view if they didn't actually have evidence to support that opinion. So in either of those cases, either because there's something which is wrong in the financial statements or the notes, that whole 5 elements of the financial statements, or if the auditors can't get sufficient appropriate audit evidence, then you have a modified opinion. And the modified opinions are of 3 sorts. You can have a qualified, which is really saying except for. So this is really saying, except for the fact that we were unable to count the inventory, the financial statements show a true and fair view. So what the auditors do is they kind of isolate this difficulty and say, well, we don't know about that, but the rest of the stuff's all right. If the error or the lack of information, if it's what's called pervasive, in other words, it's really, really large, it's almost affecting all of the financial statements, it's really saying the financial statements are not worth the paper they're written on, then the auditors would say, if there's an error, they would say the financial statements do not show a true and fair view. Or if there's a very large missing piece of evidence there, they would say, we have no idea whether that's a disclaimer. We do not know whether the financial statement showed true and fair view because of this huge lack of evidence. By and large, the directors don't like to see any of these modified opinions. It implies that they've prepared the financial statements incorrectly, or they haven't been able to supply the auditors with the evidence that most people would expect to be there. Now, it's important to understand what the auditors do not do. They do not prepare the financial statements. It's almost impossible to prepare something and then to check it yourself, review it yourself. There are huge dangers in that. It is management's responsibility to prepare the financial statements. Occasionally, in very small clients, one team from the auditors might prepare the financial statements, but an entirely different team of auditors would then perform the audit. Auditors do not double-check every transaction in the company. Just think what that would be like in a large company like, say, BP. You can't expect the auditors to come in and kind of duplicate every transaction that was made. So very much auditing is done on a test basis and makes use of really statistical results, which we can then say, well, we haven't found any errors in these 50 things we've looked at. We are kind of assuming there's not errors anywhere else. It's a little bit more sophisticated than that, but don't think auditors go through everything. They don't manage the company. That is for managers to do. They will not warn the shareholders when the company has produced a loss. It'll be obvious from the statement of profit and loss that there's going to be a loss there. They do not particularly warn the company that they think that the shareholders of the company isn't doing very well. The auditors are principally there to say that whatever in the financial statements you can believe. Auditors do not undertake to discover every fraud or error that may have taken place in the company. Remember, many errors can be small, many frauds, we don't like fraud, but many frauds can be very small. And to find these small amounts, again, is not economically worthwhile. And auditors, therefore, do not provide guarantees that the financial statements are free of material fraud or error. What they give is what's called reasonable assurance. And of course, if you haven't looked at every transaction, you can't give any sort of guarantee. So auditing is very much kind of risk-based. We look at transactions on a test basis. We may look at more of the very large transactions and the very small transactions to try to cover more by value. But they certainly don't look at everything. They don't undertake to find every error, every fraud, because many frauds are very skillfully concealed and can be very difficult to uncover. The advantages and disadvantages of external audit. Well, there's an independent scrutiny and report on the financial statements. This adds credibility to them and might, for example, make it easier for you to go to your bank and to raise capital. It should be said the auditor report is to the members. It is not there for the bank, but banks will look at it. This greater credibility, this independent scrutiny, gives everyone a feeling that the financial statements are kind of more respectable. Professional expertise is applied. There are nowadays many complicated accounting standards and so on, and really it is quite a specialist job to keep up to date with those and to make sure the financial statements comply. And the auditors also review what's called the internal control system of the company. We'll see this later, particularly in the next chapter. But the internal control system is, for example, how do we know that people aren't claiming overtime that they haven't worked? How do we know that suppliers aren't sending in kind of bogus invoices for goods they haven't supplied? and the auditors look very carefully at the internal control system. Disadvantage, there is considerable cost involved, and certainly for small companies, they can be exempt from audit, simply because the directors are probably also the owners in the small company, and the idea of having to have this independent scrutiny isn't quite as powerful. There is disruption. The auditors come in, they may spend a couple of weeks there, and the way they do their work is they come in and they ask people questions, They say, where can I find this invoice? Where can I find this purchase order? And going hand in hand with that, there is maybe a feeling amongst client staff that they're not trusted. So somebody says, well, yes, we always authorize purchase orders. And the auditor says, well, could I see some purchase orders so that I can make sure you actually signed those as authorization? But people shouldn't take it personally. It's just the way auditors have to do it. They have to get sufficient appropriate audit evidence, and simply oral evidence isn't actually very good. They usually want to see some documentation. Internal audit, it's defined here as an independent appraisal established within an organization as a service to it. And this is going to be established here by management. Okay. There is no requirement for companies to have an internal audit, but they have to keep it under review. It's a control which functions by examining and evaluating the effectiveness of other controls. So, we were saying, what we might be worried about is it possible for employees to put in overtime requests just because they need a bit more money, even though they haven't done the work? And there would be, we hope, some sort of control that maybe the employee's manager would sign these requests as evidence the employee has actually done the work and should be paid. Well, the internal auditors will go and pull out a load of overtime requests and make sure they have been properly signed off by the manager. So internal audit is a control, and it is examining the functioning and adequacy of other controls. And it goes wider than just financial controls here. It analyzes effectiveness of all parts of the entity's operations and management. And we'll see in a moment just a list of the sort of areas that internal audit can get involved in. So here we are, transactions audit. Transactions audit, they can follow through a purchase order all the way through to when the invoice is paid. So there's how do we raise the order, how do we know we need the goods? There's have people found a good price for the goods we're ordering? Do we get the goods in a reasonable time? When the invoice comes, does it agree with the goods we've got, and do the goods we've received agree with the order? Have we paid the right amount to the supplier after the reasonable amount of credit has been taken from that supplier? So is that kind of working efficiently? Systems audit looks at IT. Are people, for example, taking regular backups in case something goes wrong with the computer that could put your record keeping at risk? Accounting systems audit. Have we got controls in the right place? Operations audit. For example, how do we go about recruiting people? So there are rules and regulations about making sure you don't discriminate unfairly against people. There may be health and safety audits to carry out. There may be audits on how we make sure that the quality is okay. Now, the internal auditors may need to bring in experts in these areas, but it's important that you recruit properly, that your internal control is being established over health and safety properly, that quality control is good, and so on. You can't just assume all of these operations are working properly without some form of scrutiny. Value for money audits and best value, frequently done by public authorities, councils and so on. So councils will be thinking, who should be responsible for cleaning the streets? Should we employ people ourselves, or maybe it might be more cost effective to subcontract that to an outside firm, and we'll establish, standards of the work being done. Social and environmental audits. Social can look at the makeup of your staff. Environmental audits, we can be looking at what percentage of waste is recycled. Have we managed to increase the thermal efficiency of the factory by putting insulation in and so on, so that our carbon footprint goes down. From time to time there'll be special assignments. So management discovers there's a fraud, and management will want to know, how much has been stolen, who's been involved, how long's it been going on for, how did that happen, how can we stop it? And this is very much the sort of thing that internal auditors can get involved in. And then there's assisting external audits. Instead of, let's say you have a string of shops, 20 shops, it can be quite difficult for the external auditors to visit 20 shops at the same time to count the inventory. So maybe external auditors will visit 4 shops, and they will get internal audit to visit the other 16 shops, and then external audit can review the work done by internal audit. And finally, the main differences between internal and external audit. Internal audit reports to management. They could, in small companies, be reporting to the finance director. In larger companies, it's going to be the audit committee. This can be a little bit uncomfortable if you're certainly reporting to the finance director, because internal auditors might find something wrong with the financial accounts or the recording of information, and it's the responsibility of the finance director to make sure it's right. So you're kind of criticizing the finance director, and the finance director might be the person who actually gave you the job. So that's why an independent audit committee with non-executive directors gives the internal auditors a bit more power. External auditors, as we've said, report to the shareholders and are appointed by the shareholders. So here are the 2 appointments: internal auditors given their job by management and directors. External auditors are appointed by the shareholders, perhaps on the recommendation of directors, but it's the external auditors who have the final say. Power for internal auditors derives from management. Management will say, yes, you can look at this and this and this, but you can't look at the board minutes, which could be, quite a gap in the information required by the internal auditors. In external auditors, their power comes from law, from statute, and it allows the external auditors to demand and to look at any document they want and to require of management any explanation that they require. So it puts them in a very, very powerful position. Internal auditors are employed by the company. Very often they are employees of the company, though sometimes it can actually be outsourced to a third party. External auditors are always employed by an external firm of auditors because you want that independence. You don't want your job dependent on giving a good report. Coverage. Internal auditors, as we've said, can be looking at fraud, systems audit, transactions audit. They can be looking at the efficiency of recruitment and so on. Much more confined in external audit. They are focusing very much on, do the financial statements show a true and fair view? A major function of internal audit is to try to improve what's happening in the organization, make things more efficient, for example. External audit do a little bit of that. They do review internal control, and they report to management where internal control could lead to fraud or error. And they say, look, you're not authorizing overtime. We think you should authorize the overtime. Otherwise, there could be excess amounts being paid to employees.